Yep. Yeah, you do. You actually do. Just one this morning. It says if stocks are indeed in a bubble, would the reference point be the prior all-time highs in valuations, thus making stocks effectively cheap?
Cheap, yes, I guess. So now we need to define cheap, because what people tend to do is they cherry pick something just to say it looks cheap. Now, over the years, people have gotten a little smarter than that, so people sometimes cyclically adjust earnings. This is from my old professor at Yale, Mr. Schiller, the CAPE adjustment to earnings. So if you look on CAPE, they're wacky expensive, as expensive as they get. If you look at the Russell 2000, this is interesting. Because some people say, well, look at the S&P, it trades at 19 times earnings, that's just cheap. And they'll say it's cheap relative to 1999 because in 1999 the S&P traded at 30 times earnings. So they'll use the all-time tulip bubble peaks as their reference point for what is cheap. Now, this will get confusing for those folks. I'll be on the road today and I'm going to throw that little curveball at them. I'll say, but the Russell 2000, which is more stocks, maybe a broader look at the US stock market, trades at 55 times trailing earnings, non-cyclically adjusted. I mean, this is like, that's, you know, it's unfortunate that some of these things don't agree with the market being cheap. This is not a cheap stock market. No, the only thing that looks cheap to me is something that isn't hitting all-time highs, which are bonds. At 1.7%, then I'll say the 10-year Treasury is not cheap.
Indeed. We'll wrap it up there, folks. Thanks for joining us this morning. Catch you back here tomorrow, same time. Have a great day out there.